Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The luckiest guy on the street, Georgetown Johns Hopkins academics, is Axel Pelle. I don't know how to pronounce his last name. He gets to work with Steve Ricchiuto over at Mizuho each and every day. Steve Ricchiuto joins us right now as he provides wisdom to Alex and also to us on the American economy. Steve, adjust for inflation, as all of our listeners and viewers have to. Are we growing adjusted for inflation?
I think we are growing adjusted for inflation. I think we've got a fairly healthy growth rate outside of the inflation environment. But I do think it's a little bit too hot for the inflation environment. Even the chairman indicate that in his post-meeting policy statement, where he talks about the Fed's mandate, dual mandate being in tension. Basically, the inflation numbers are running hotter, but they have the weaker labor market numbers. And I think you're getting a bit more productivity helping out the overall real side of the economy.
So, Steve, going to the labor side of the economy here, I mean, if you just look at the headline, unemployment rate, it seems pretty darn solid, if not close to full employment here. How do you characterize this U.S. labor market?
Well, I mean, like everything else, everything is a bit of a tale of two stories. You've got in the economy, you've got certain sectors of the economy that are doing extremely well, and you've got certain sectors of the economy that are not doing very well. I think when you look at the labor market as well, you're seeing certain components of the labor market, like the unemployment rate, because there's a scarcity of workers that's holding the unemployment rate down. But by the same token, there's a greater uncertainty out there in the business community about where we're going, how sustainable things are, and therefore there's a bit of a reluctance to hire workers. So you wind up with the employment numbers coming off a little bit, but you wind up with a tight unemployment rate remaining an important component of the overall labor market environment.
So I guess with that background, Steve, the Fed has begun cutting rates with that 25 basis point cut. How do you think the cadence will kind of play out over the coming meetings?
Well, I think you're probably going to definitely get an October meeting. We put in 3 after the last payroll employment number. I do think the December meeting will be more data dependent than the October meeting. And I think any meeting thereafter will also be more data dependent. It's interesting. The chairman was able to pull off an insurance rate cut against the dot plot, telling you 4 rate cuts were coming in fairly rapid order by talking not just about the fact that the dual mandate is in opposite directions, but also getting into saying what we're really looking at is the risks underlying those dual mandates and making a determination based on those risks. And therefore, it is an insurance rate cut, and they've given themselves that out.
We welcome all of you across the nation this morning, the way you listen to us. Good morning, 99.1 FM in Washington, 92.9 FM in Boston. A little bit of serious baseball starting today for the dreaded Toronto Blue Jays. We'll have to see on that. Good morning, Bloomberg 1130 in Miles Miller's New York. We continue with Steve Ricchiuto on YouTube. Steve, you mentioned 3 rate cuts, but in your research note, you say the market's priced for 6 rate cuts. If we don't get market pricing on Fed easing, in all your experience with Dominic Constant, what does that do to the stock market?
Well, I think the thing is the Fed's not going to change the long-term target for the Fed funds rate quickly. So therefore, the concept of whether we get to 6 rate cuts or not is going to depend on the data, and the data will determine it. But I don't think they're going to change the idea that their view on neutral is to get back down to 3%. So then in that environment, I think you avoid a lot of the worst case scenarios that you would get if there was a sudden reprisal in terms of monetary policy. The dots are very, very important in terms of grounding the market to certain levels. And unless that grounding changes, which we don't see happening quickly, we're not going to have the end result volatility that people would be concerned about normally.
Paul, is it too early to go nerd? Sure. Can we go nerd?
No, I think
okay, I get permission from Paul to go nerd. Okay, Steve, what's roaring here after the Myron speech is a Taylor rule. The Bloomberg has a beautiful function, TAYL, so you can do your own Taylor rule. I got so upset about it, the certitude, the lack of humility in the speech, Steve Ricchiuto, that I looked up Robert Hetzel, a paper I remembered from the Richmond Fed like 25 years ago, maybe 28 years ago, and he quotes the giant Orphanides as well, that a little humility is in order in guessing the output gap, guessing Nehru. Have we lost our academic humility when we try to game this odd economy?
Well, I think what happened is in that period post-financial crisis and immediately post-COVID, all the normal algorithms got distorted. Yeah. And therefore, there is a data set that supports things like Stephen Mirren was talking about yesterday, which is basically a zero R-starred environment. Again, I don't think we're in that environment anymore. We don't have the balance sheet related issues that existed then. But that kind of distortion is still out there. But again, I think to a certain extent, he's pushed himself to an extreme. And I think that will minimize his vote to a certain extent.
Thank you. That's just what I wanted to hear. With that said, do we have the institutional courage, Steve Ricchiuto, to push against a zero R-starred or the 8 other flavors of that expansion, that lack of restrictiveness?
Yeah, no, I think the committee in general tries to do a good job. I think the committee members are focused on doing a good job. I think the research staff tries to do a very good job and a good thorough job. And I think they do a good job of informing the board and the members of the committee. And I think in that environment, it's the institutional portion of it that becomes more important than the 1 or 2 voices that are leaning to one aggressive side.
Steve, how's the U.S. consumer doing? We had some pretty solid retail sales a week or so ago, and boy, we hear about some of the challenges out there, but the consumer seems to be hanging in there. What do you think?
Well, again, even though we're not hiring a lot of workers, we're working people longer, we're paying them more. And the net result is you have consumer spending building on top of that. And again, that's a little bit of this tale of 2 different economies. There are aspects that are doing well and there are aspects that are not doing well. You've got an economy that has very, very accommodative financial markets. It's an economy that's benefiting from excess liquidity. It's an economy that's benefiting from strong balance sheets. You put all that together, you've got a healthy economic environment. If you're not generating employment, you're generating hours. If you're generating hours, you're still generating income. If you're generating income, you're generating spending.
Steve Ricchiuto, thank you so much. Greatly appreciate it. With Mizuho, stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us, Liz Ann Sonders. People don't, Liz Ann, you're so ubiquitous and, definitive since Lou Kaiser and all. People don't actually read your note. And the end of the Liz Ann Sonders note today is absolute gold. Let's start with this. Only 17% of S&P 500 are outperforming the index the past 3 months and past 1 year. Does everybody own that? The exuberance out there is everybody owns NVIDIA, right?
Yeah, even though within the Mag 7 you're seeing dispersion. So 4 out of the 7 are underperforming the S&P 500. But you also have to think about the difference between the performance of some of those top names and the contribution. So NVIDIA is the best performer year to date among the Magnificent Seven, but it's the 47th best performing stock in the S&P 500.
And Apple's 318th until the last couple of days.
Right. It just had a little bit of a lift. Actually, in terms of contribution rank, NVIDIA is still number 1, but as of a couple of days ago, Apple was number 503 within the S&P 500.
How do you do that if there's only 500 stocks?
It's because 2 classes of service by Alphabet and Berkshire Hathaway.
Only Kevin Gordon knows that. Okay, I got to ask this right now. What are Schwab clients doing?
Depends on the Schwab client. So we, a lot of the inflow of new client assets for us are actually younger investors. I almost said that with air quotes, but of course we're on radio, although on YouTube as well. Yeah. So I think there's a big differentiation these days between what retail traders are doing and thinking and what individual investors are doing and thinking. I will say that I have a little bit of a sour feeling, given some of the anecdotal conversations I've had with even some of our, let's call it more seasoned, ostensibly disciplined investors. I had two investors at an event I did a couple of weeks ago, a great event at Churchill Downs. I've never been before. Okay. Super cool venue. One said that her last two stocks that she had bought, she got from a TikTok influencer, and she didn't even know the name of the person, didn't quite know what she had bought. And another said that she had bought two stocks because the tickers were her initials and her husband's initials. Okay. So those anecdotes are a little bit unsettling, but I still believe that that's the exception, not the rule.
How should we think about this concentration risk that we hear about so much? It's been expressed to me in so many different ways in terms of move in the market cap, but they're the biggest earnings contributors, so don't worry about it. How do you guys think about that?
Well, they are the biggest earnings contributors. That said, it's a decelerating pace of earnings growth. Okay. It depends on what cohort you're talking about. If you're talking about the Mag 7 or the 10 largest names or AI adjacent, yes, the earnings profile has been significantly higher than for the rest of the S&P 500, but at a decelerating pace. I think that was part and parcel to the pullback we not only got in the major averages in that mid-February to early April period of time, but the further drag on performance was many of those leadership names. Memories are short, though, so a lot of the players in those names don't remember as recently as just earlier this year.
Across America, Ann Sonders with us this morning on the way you listen to us on Bloomberg Radio. Good morning, 92.9 FM in Boston, 99.1 Nathan Hager Radio in Washington. As well on YouTube, subscribe to Bloomberg Podcasts. That's what the hipsters do, like Kevin Gordon as well. We're on YouTube, and thank you for that. Paul?
So, Lizanne, talk to us about earnings, because at some point, earnings really have to come through, and arguably they did here so far this year. Earnings, second quarter earnings, very strong. How do you think about it in the back half of this year going into next year?
Yeah, you're right. When all was said and done in the aftermath of first quarter and second quarter reporting season, actual earnings were about double what the estimate was heading in. And what was interesting about that first half is there was limited extrapolation on the part of analysts into the second half of this year and into 2026, maybe justifiably because of uncertainty with regard to policy. That, you could argue, sets the bar sufficiently low as we approach third quarter earnings season. But I also think that there's a risk factor in if either one or two high profile names misses on earnings, or you just get an aggregate reporting season that is not quite as robust as it was in the first half of the year. So when I think about, I'm paid to assess risks, not just opportunities. And I think either some very specific earnings misses, I don't think that's the base case, but I think that's a risk factor.
A wonderful tweet out today. I highlighted it in the last hour. Paul Tudor Jones talking about the challenge of investing in the back third of a bull market or the back third of a bear market. Let's first identify, does Ann Sonders think we're in the 7th, 8th, 9th inning of a bull market?
Yes. I would say what we don't.
What are the characteristics?
What we don't know is whether it's an extra innings bull market like in the late 1990s.
Yeah, going to put NVIDIA on second base. Okay, great. We're at the back end of a bull market. How do you behave? What's the best practice?
So, notwithstanding baskets like the meme stocks and heavily shorted stocks and non-profitable tech, which are dominating performance at the sub-cap weighted index level since the April 8th closing low, I think you want to fade the low quality part of the rally and lean into higher quality. In fact, I'll use an acronym that was more popular 20, 30 years ago, and I've been doing this almost 40 years. I think the way to think about factor investing in this environment is less about traditional quality factors, but almost GARP. Yep. I think you don't want to sacrifice growth, but you want to have that eye on valuation. I think
Define
it's the blend.
GARP for those that have never heard the phrase.
Growth at a reasonable price.
Okay.
That foreign concept.
You don't do individual names, but Walmart with a PE of 40, I don't think that's GARPy, is it?
Maybe not. And that's why I think you want that blend. You want
what
reasonable.
What sector gives you the best blend?
I think monolithic sector-based investing doesn't make sense in this environment. So even the leadership sectors like tech and communication services have a lot of losers embedded within them. So I think factor-based investing.
I know the answer to her questions. Brockton, it's not that hard with Liz Ann. On a factor basis, what is the most attractive factor nature of the Mag 7?
Well, they have often been the momentum players. Now, that said, when momentum is discussed as a factor, it's more of a concept. It's not a fundamental factor. So when momentum as a factor is working, it just means that the stocks that have been working continue to work. You can have momentum in utility stocks. Right. I think people, when they hear momentum, they automatically think to high beta tech adjacent kind of names. Right. But I think outside of that, I think you still want to look for strength in balance sheet, strong free cash flow, high interest coverage, reasonable valuations on a PE and a price to book. But you want to also keep an eye on the growth side of things. So positive forward earnings estimate trends and positive earnings announcements.
Liz Ann Sonders, thank you so much for being with us. Real commitment to surveillance over the years. She is with Charles Schwab. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
In an equity bull market, one thing you do is you watch bonds. That's a cardinal rule. Bonds are out front. Sinjin Bowron with us now. High yield bonds, senior bank loan portfolio manager at Beach Point Capital Management. Love your note. And my basic idea is bonds see the agony first. Is there any agony in bonds right now, or is it the same madness as an equity bull market?
Well, first of all, good morning. Thanks for having me. I would say it's both. Similar to other risk assets, leveraged credit shows fairly rich valuations at this point. In high yield, for example, there are a lot of double B rated bonds that trade inside of 200 basis points over treasuries. In senior loans, over 2/3 of the senior loan bank market trades above par.
So you don't see stupidity yet in bonds?
Well, we do see dispersion.
I'm talking like an equity guy where I wouldn't know convexity if it hit me over the head. Is there stupidity in the bond world that I need to be worried about?
Probably not to the same extent as in other risk asset classes. Credit fundamentals continue to hold in very well. In this macroeconomic backdrop, credit tends to perform well. And so there's not a lot of excess in terms of irresponsible credit creation that's taken place over the past few years. And so to the extent that we do get problems within credit, they're usually idiosyncratic, either related to the specific issuer or to the sector. And that's usually an impact from one of the surprise policies that we've had over the past year, potential geopolitical risk or something that crops up that poses surprise. And again, similar to other asset classes, just given where things trade, it is an asymmetric payoff if you do get something wrong.
The new issue market is just ripping. The desk can't get this stuff off their books fast enough. Is it too much supply coming in the marketplace? Are you guys buying? What are you seeing when the desks call you up and say, hey, we've got another deal?
Yeah, well, there are two sides to the coin. On the one hand, the market's open. So a lot of companies across a lot of different sectors and, up and down the credit quality spectrum are able to access the market, refinance near-term obligations. And so that maturity wall that was a problem during the rate hiking cycle isn't really one anymore. And so, access to capital is an important component that staves off defaults and therefore credit losses. But at the same time, there are periods of time when the market becomes technically imbalanced, where the amount of supply it's too much for the market to absorb. We're not really in that right now in both high yield and loans, especially in loans, given the amount of net new CLO creation, which is the major buyer for senior bank loans. That's very much in favor of issuers at this point.
Back early in my career, I cut my teeth at the Chase Manhattan Bank, making leverage loans to the TMT space. We made a small fortune doing that. How's that leverage loan business today? And how much is going to private credit?
Well, the market share shift between private and public, and we at Beach Point, we do both private and public. And so we sit back and we can see, what are the trade-offs between the markets and how these companies choose to finance themselves and what levers they want to pull on in order to, get the capital that they want or need. And so that share shift changes depending on the technical inflows and outflows between the two asset classes. And so for a while, private credit was taking share from the broadly syndicated market. Yep. That's now turning around a little bit. And so it comes and goes.
Yeah, but there's a little private equity angst out there in the zeitgeist this morning. Do you sense angst within private credit? We get all sorts of cross messaging here. I'm hearing things I heard 30 years ago, the same phrases and all that. Sure. You've got the radar up on this, particularly with loans. What's your take on private credit? Are there shadows out there we need to study?
Yeah, well, commonly through market cycles, a rule of thumb is if you want to know where problem areas are going to be, look at where the most credit has been created recently. And private credit does fit that profile. And so you do see right now, for example, a higher backward-looking default rate within private credit than you do in public credit. But at the same time, those vehicles are equipped with different mechanisms to be relatively defensive. There's still a lot of capital that's waiting to be deployed within that market. And so the ability to navigate these different situations of higher defaults, you may stave off credit losses.
Sinjin, thank you so much for joining. Sinjin Bowron with us from the left coast with Beach Point Capital Management. Greatly appreciate that. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Joining us on Margaret Franklin, the CFA Institute. Full disclosure, I'm a member of the CFA Institute. It's where you take 3 exams and you try to pass them, and they're very British in that they throw a wall of stuff at you and you flunk, and then you pass. It's a rite of passage on Wall Street, and it's gone worldwide. So Margaret Franklin's in Toronto, cushy job, the whole thing. And in September 2019, she gets this piece of cake job to run the CFA Institute. How about that COVID? It showed up 4 months after you dropped in. How did the CFA Institute survive COVID?
Well, Tom, actually, testing times give you the opportunity to really change the trajectory. So you talked about the exam being that wall of material and testing. We actually took the time we had to go from paper-based tests, which you would remember, to computer-based tests. And that was really reimagining how we can make it more learner-centric. So modular, mobile,
it's
same
way better
rigor,
now. It's way better.
It is. And it's the same rigor. It's the same quality. But at the end of the day, the idea is not to fail people. It's to demonstrate that you have the knowledge, skills, and ability, and I think the program really does that.
My life would be different when I was 20 with perplexity, or when I was doing CFA. Thank you, Fidelity, for telling me, just shut up and go get it. Perplexity. Show the difference between the 3-ratio or 5-ratio DuPont analysis. It's laid out perfectly like CFA level 2. How is perplexity and AI going to change the capture of knowledge?
So we think that AI, that stack on top of the intelligence stack, is really important. So if I look back 2 years ago, certainly subject matter experts were really anxious about their role within almost everything. And what we find is that the subject matter experts, those who know, become really valuable. They know the questions to ask, and they know how to evaluate the output on the way out. So the CFA program and actually the broader portfolio that we offer becomes, I think, more important because you need people who actually know what they're doing to be able to capitalize on really extraordinary things that AI can offer us.
Yeah, but like Whitefried Sandy was, Paul. It's like 600 pages. It's got a John Deere. I never got equipment leasing. I flunked it 3 times. Margaret, is AI going to replace the torture of readings V. Bodie up at BU or Whitefried Sandy Accounting?
Well, the program actually is looking at the modality within which we teach it. So I think the core content, obviously modernized for what's important now, it is still the foundation of it all. But how we teach it is increasingly more accessible and more effective.
Paul, surveillance correction. White, Sandy, and Fried. Oh, I mispronounced.
All right, very good. Margaret, what is Global Wall Street asking of the CFA Institute these days? What skills do they want? What competencies do they want? Maybe.
So what we've heard from employers loud and clear is the knowledge is great from the CFA program. It differentiates. It says something about your commitment, discipline, and ability to master a really complex body of knowledge. But what they are really focused on is making sure that candidates are much more job ready when they arrive. So we introduced our practical skills modules in this current curriculum. But we have a strategic initiative to really advance our skills learning. And so that'll be a feature of the next iteration. And of course, AI allows us to do that so much better.
It is United Nation Week here in New York. It's Climate Week. Sustainability, ESG, it seemed to be really important in the financial marketplace for a while. In the U.S., it seems to have faded pretty significantly. But I know outside of the U.S., that whole concept of sustainability and incorporating that into your financial analysis, how do you guys approach that?
So what I would say about sustainability is it's matured over, let's call it 10 years ago when the tragedy, the Horizon speech was, and certainly the last 5 years. It is not going away. It's just not being talked about as much. And why is that? Because climate risk is financial risk. It's financially material. Asset owners, when we look at pension plans, sovereign wealth funds, they are not walking away from it at all. The skills required for it, though, are being incorporated much more into mainstream portfolio management, risk analysis, and investment research. What I will say is that the opportunity set is different than it was 5 years ago. It's investable, it's scalable. The cost curve coming down on, for instance, renewable energy makes that much more attractive from both a risk and return perspective. So I don't think it's going away at all. And in fact, our numbers bear that out. We have over 50,000 people who have taken our stack on our sustainability certificate and that broader stack. So we don't see it going away.
I haven't done that. Don't let her know.
Tom, there's still time. We'll send you the
H-1B. Yeah. Okay, I remember the desperation of well-meaning Indians wanting to take CFA 1, 2, 3, and like they had to fly to Dubai. I can't remember during COVID. I mean, immense commitment on the part of these kids. You're away from the H-1B remit, but nevertheless, the CFA Institute impact in India is extraordinary. Color that for us.
So I think India is a great example of the globalization and the interconnectedness of global markets, and that CFA provides that. CFA provides ethical training, very high quality education, but also a common language. And we see that everywhere in international markets, that they want people talking the same language as they export capital and import capital. India is our number one market.
Really?
It's our number one candidate market. And that reflects two things. One is, the diaspora is everywhere. But importantly, India as a capital market and as a service provider to the financial markets is increasingly becoming more sophisticated. And so again, that CFA program and charter becomes a distinction for that market.
Is there going to be CFA level 4? I've been asking for 20. I'm sitting there with some panel with Michael Mobison. And we're like going, we got to reach out. There's got to be more. Is there going to be CFA level 4? Expand it. I need the agony of 6 months gone.
Well, Tom, what we have on offer for you is an expanded portfolio with increasing specialization. So we have our sustainability stack. Private markets are increasingly important and a permanent feature in portfolios. So we have a private markets stack. There are specialized learning for people who are changing careers, want more specialized as they advance in their careers. And that hasn't been available prior. So it's very important.
John Tucker, what do you think? CFA radio blather?
It just sounds like torture to me.
Preparation.
It's fun, John. It's fun.
It's fun.
How much time am I going to have to invest in studying to pass all levels?
To pass all levels, it still remains 300 hours per level. You can
level.
do it. You can do it. 900 hours. It's engaging.
I've sponsored
with that.
42 kids for the CFA.
Yeah.
The rite of passage for me, you take the exam and you're certain you flunk every time you take it. And we would go down Newbury Street in Boston to some shishi bar I can't remember. And one night I'm there getting completely plastered after CFA level, whatever. And Cam Neely's sitting next to me, like, 6 feet away. And he goes, why are you here? Blah, blah, blah. And giant of the Boston Bruins. Oh, I took an exam in finance and I had another beverage of my choice to get through.
What's the latest pass rate for level
Pass
1?
rates are back up. So
They're back up,
They're
yes.
back up. So they're back up to historical norms. Level 1s are at around 45%. But interesting you ask that. We have offered deferrals. So if you can't take it, you can pay to get a deferral. And actually, the deferred candidates are performing really significantly below the average. And so for all of you candidates who are out there, don't defer. Yeah, tough it out.
Yep.
Tough it out.
It's a guy, Standish Ayer, years ago told me in Boston, it's a rite of passage. Margaret Franklin, thank you so much for joining us, her leadership at the CFA Institute.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.